Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value, and the channel, it mainly talks about commodities just because that's what's undervalued at the moment. But if you're looking for undervalued investment opportunities, click subscribe. This is the channel for you. Ride this bull market up with me and everyone else in our community. We are trying to make money in commodities. I wanted to put together a presentation on making money in commodities so you guys know what to look for, where the risk is, where the returns potentially could be. I'm going to go over all that stuff. So this is how you make money in commodities. This is how you, I think, want to look at a portfolio and set it up. Again, this is just my opinion. This is not financial advice. This is just financial education and my opinion on it. So how to make money. Commodities are different than other companies. Commodity companies do not set the price of what they sell. The markets do. So what happens is you have these excellent companies, they get sold off during bear markets in the commodities that they sell, and they create this insane value for an investor. And I want you to be aware of different types of companies and the value and risk to shareholders of these commodity companies. So what I want you to know is that there's different stages in these commodity companies. There are exploration companies. What they do is they don't have any value per se in the beginning, and they create value by finding a deposit. And then we've got the next level, which is developers, and they're developing a mine. They have deposits, but they're turning the deposit into a mine, and they're known as developers. And then you have producers. Producers have the infrastructure in place and are producing from a mine or well or whatever it may be. This is the life cycle of a mineral discovery. These were all the exploration companies are all over here. This is where you start to speculate on drill results. They're drilling and looking for things. And if they find something, this is when you get a large move higher. This is the value that is created for shareholders. Then between the initial discovery on the deposit and when it becomes a mine, people usually sell the stock off some, and you've got this period where they call it the orphan period, where the excitement wears off and it requires large amounts of capital for construction. So they're not receiving cash flows. They have to raise money, and the stock falls. Then they develop the mine. They build the mine. This is the excitement before the mine starts to produce. This is the move up. And then eventually the mine starts to operate and it rolls back over. But that highly depends on the price of the commodity itself. But this is the cycle: exploration, developers, and then producers. And producers move up and down, and their cash flows move up and down with the price of commodities. So the value, when a commodity goes into a deep bear market, opportunities arise. The best value are companies that produce and explore while being a high-cost producer. And if they have some debt that are run pretty well, you're going to get insane value there. They have infrastructure in place to produce, but the cost of the commodity went below their cost to produce. So what happens is, if they have any sort of debt and they're a high-cost producer, almost everyone sells these companies off, and most everyone avoids debt. So they just get sold off massively in a commodity bear market. They can get sold off to 0.5% or 1% of their all-time highs at the top of a bull market. That is incredible value if the commodity can turn around and go into a bull market from a bear market. Insane value in some of these companies because of the bear market and what people have done and sold these things off. But there is risk involved. Searching for leveraged returns in the most undervalued companies, that's a high cost and higher debt company, comes with risk. These companies can go bankrupt in commodity bear markets, and it's the very reason they get sold off so much to create great opportunities. Commodity pricing is the most important piece of commodity producers. So think about that. The commodity price is the most important piece of a commodity producer. You must time these investments well. If you do not time them well, you get crushed. If you time them well, They are one of the most rewarding sectors of any sector. So I'm going to go through the exploration developers and producers. These companies have high risk, high reward, as these companies are searching for value. Value can be created very quickly in these companies if they strike it big. And what my approach has been, since these are much higher risk, I tend to underweight these companies, but I do have exposure in case they hit something big. I just don't hold that many of them. I do hold them. I do hold some of them, but it's not the bulk of my portfolio. Now, developers. I do invest more heavily in the developers versus the explorers, as they have deposits, but they are developing them into mines. Be careful with some of these companies, as they need money. They need to raise money for the mine development. They can issue lots of shares to raise capital to build their mines, and they dilute you as a shareholder, which is negative for shareholders. They dilute your stake in the company, and they dilute the value that is attributed to your shares. But developers do have a lot of upside, especially if they have very good deposits. Producers are the lowest risk, and they are generally priced much higher than the other companies, and for good reason. In terms of how much dollars you're paying for pounds in the ground, or dollars paying for oil in the ground, or whatever it may be. If you can get a producer company at a very low price during a bear market, these can be great. I mean, absolute great pickups. Producers can also explore and add value this way while funding explorations and development of more mines through cash flows from producing mines. And that is an excellent way to make a bunch of money and for a company to grow and expand. High-cost producers usually get sold off the most during commodity bear markets. And I want to give you an example here. I just grabbed it from 2017. It doesn't really matter. They don't change that much. This is South African Platinum Mines cost curve in 2017. If you look on the right-hand side, when the price, this line here is the price of platinum. It fell below the cost to produce platinum for some of these companies. Impala Platinum is one of the companies that is a high-cost producer. The price fell below Impala's Platinum's cost curve, which means they were losing money or they had to shut down their mine. And we're going to see that in the price of Impala. So let's take a look. This is in 2017. We're going to see Impala fall probably 2017 and onward. And that's what we're seeing. It fell and fell and fell, and platinum bottomed in 2018, 2019. And what we see here is a great value for a buy. This was below $1 in this time frame. And what did you see? When platinum went up, this is a high-cost producer, it went berserk to the upside. We had the COVID sell-off, and then it continued to move on higher because structurally, it needs to be produced. So this is a cool one to watch and move higher. Another one, SM Energy. This is one that I purchased. It's an oil company. Oil got sold off massively in the beginning of 2020. What happened is oil went negative and everyone got scared. Fear was in the market. Blood was in the streets. And everyone sold it. And what I see here is an absolute incredible opportunity right at this tip that I bought. You can even see that there's a line coming through here, right to that tip, and another line coming right to that tip. Super great entry point. Probably one of the best I've ever seen. They do have debt, and they do have a well-managed team. It is a middle to high-cost producer, and I figured this thing would rebound pretty good. And it rebounded pretty good, and we're sitting here kind of relaxing. We do have some buyers and sellers all through here, and I think eventually we'll break through this and move all the way back up and break these highs 4 or 5 years from now, or maybe sooner. We'll see what happens. I do think this bull market is going to send these prices higher than the all-time highs. So the portfolio here, when you try to put this stuff together, position sizing is critical to reduce risk. 1 to 5% position sizes is where I like to be. I usually have small allocations to explorers, more like the 1% area. And I up my allocation to companies that are producers but have been sold off because of commodity prices. That's my 5% allocation. Developers have a spot in the portfolio as well, and they're in between somewhere of that 1 to 5% allocation, depending on how much I know about the company and how bright the future of that company looks. So deep bear markets, not many companies survive the deep bear market in uranium. And few companies exist, and the developers will need to develop their mines at some point to produce for world demand. So I'm a big uranium bull because there's not many companies in the sector right now. So the opportunities are very large in that sector. And if all this money is going to flow into it, there just isn't that many companies to really absorb that money flow. Oil, precious metals, etc., they're different as they have a lot more explorers and developers and have not endured as long as a bear market as uranium. But I will say that oil did have a short, massively sold off condition in March 2020, which got me extremely excited to be looking in that sector. So my favorite sector right now is uranium because we're still below the cost curves. We are above the cost curves for the majority of oil, but we do have this rush of demand that could, pent up demand, I should say, that could come back in oil and just blow that price far higher. Precious metals, they're still good, but they are not on their cost curves. They are quite a bit above it for gold. And for silver, they're close, but they're turning out a lot more mines at the price that they're currently at. But I do think silver is going to be a very good bet as supply demand. We have a mismatch. I think we're going to go into a big deficit, which is going to push prices a lot higher. The only negative thing about silver and gold is people hold these things in their hand. There's a lot of junk silver. And if the price goes high enough, a lot of these people will sell their physical holdings or sell junk silver or sell whatever. So that is resistance to a move higher. Uranium doesn't have that resistance. Neither does oil. So usually when they start to move, there's no resistance after a certain point. It just goes and goes berserk. So that's one thing to keep in mind. If you guys like this content, give me a thumbs up. Appreciate you guys listening. This is Finding Value.